Welcome to the deep dive. You sent us some really interesting material on Mike Michalowicz's Profit First, and today, we really want to dig into that for you.
Yeah, get to the core of it.
Exactly. It's not just, saving a few bucks here and there.
Yeah.
It feels like a totally different way of thinking about profit in a business.
There really is. We're all so used to that standard formula, right?
Mm-hmm.
Revenue minus expenses equals your profit.
The classic accounting equation.
Right. But this profit first idea, based on the stuff you shared, it flips that completely on its head.
It does. Michalowicz basically says revenue minus profit equals expenses.
And it sounds like just, shuffling words around.
A simple switch. Yeah.
But the implications for how you actually handle your money day to day are, well, they're huge.
Totally. And since you're looking to get up to speed quickly and really understand this, we think this dive into Profit First will offer some solid, actionable stuff. Might even make you rethink your current setup.
Okay, so let's start with the absolute core idea.
Yeah.
This concept of pay yourself first. Because traditional accounting, like the sources pointed out, it really does treat profit like the leftovers.
Yeah, whatever crumbs are left after you've paid everyone else, if there are any crumbs.
Exactly. It's kind of a hope for the best situation rather than a deliberate plan.
You make your sales, pay your staff, cover supplies, and then, cross your fingers there's something left at year end.
But Profit First says, no. You allocate your profit right from the get-go. Take it off the top.
And then you figure out how to run the business on what's remaining.
And that's the key, isn't it? The intention. You're not just hoping for profit.
You're designing for it.
You're building a system where profit is basically guaranteed, not just a happy accident.
Which brings us straight to that mindset shift the material talks about. Michalowicz is pretty blunt, isn't he?
He is. Something like, you didn't start a business just to pay bills and salaries.
You started it to make a profit.
Yeah.
It sounds obvious when you say it like that.
But it's so easy to lose sight of, right?
Yeah.
In the middle of the daily chaos of running things.
Definitely. You're focused on customers, marketing, putting out fires.
And the actual point generating profit for you, the owner can somehow slide down the priority list.
Yeah. And the analogy used is spot on. You wouldn't wait till December 31st to decide if you can afford to pay yourself a salary for the year.
That would be madness. So why treat profit differently? It needs to be consistent, a priority.
Absolutely. And it's not just a vague concept. Profit First gives you a really concrete structure for this. It's all built around using 5 specific bank accounts.
Which is a big departure for a lot of businesses, just using that one main account for everything.
Right, where all the money just sort of sloshes around together.
Yeah, this is much more segmented. So first up, you have the income account.
Okay.
All your revenue, every dollar earned, goes straight in there. But crucially, it's just a temporary stop, a holding tank.
Like the main inbox for your money. It lands there, but it doesn't live there.
Exactly. Then, on a regular basis, maybe twice a month, maybe monthly, the sources suggest you divvy up that money into the other 4 accounts.
And the very first place a slice goes is the profit account.
Yes. This is where that fundamental flip really happens in practice.
Picking it first.
A set percentage, the suggestion is maybe starting around 5%, gets moved immediately to this profit account and this money. It's actual owner profit, not for operating costs.
It's your reward, essentially, for the risk, the effort.
Precisely. Then account number 3 is the owner's pay account.
Okay, so this is different from the profit account.
Yes. This is for your regular, consistent salary as the owner-operator. The material rightly points out, lots of entrepreneurs basically work for free, paying everyone else first.
Right, living off the scraps, if any.
This account makes sure you get paid fairly for the job you're doing in the business. It recognizes your value as an employee, separate from your profit as the owner.
That makes sense. Okay, what's next?
The tax account. And this is, well, pretty smart.
Tax time stress is real.
Oh, yeah. So here, you allocate a percentage, maybe 15, 20%, depending on your situation specifically for taxes. Put it aside regularly.
So you're not scrambling when the tax bill lands.
Exactly. It smooths things out. You could even say it uses that psychological trick, loss aversion. Once it's mentally earmarked for taxes, paying it doesn't sting quite as much.
Because you've already accounted for it leaving. Okay, got it.
All right.
And the last one.
The operating expenses account, or OPEX. This is where the rest of the money goes.
The leftovers after profit, pay, and taxes are taken out.
Precisely. And because those other things have been taken out first, the amount left for OPEX is deliberately limited.
Ah, so that forces you to be more careful with spending.
That's the idea. Parkinson's law, right? Work expands to fill the time available, while spending expands to consume the money available.
So if less is available,
You naturally become more efficient, more resourceful. You question expenses you might otherwise just wave through. It encourages lean operations.
okay, so the allocation itself is key, doing it regularly.
Yeah, that rhythm. Setting up those regular transfers from income to the other four, it builds discipline. And the materials offered some starting percentages too.
Right, like maybe 5% to profit, 50% to owner's pay, uh, 15% tax, and 30% operating expenses, something like that.
Yeah, that was the example guideline. And this is really important, those are just starting points.
Every business is different.
Totally.
Mm.
Your industry, how long you've been operating, your cash flow needs. You'll need to tweak those percentages over time. They're not set in stone.
But the principle holds. Take profit first, even if it's just a tiny percentage to begin with.
Get the habit started. That's the crucial thing. And, these target percentages, they can differ wildly between, say, a service business and a manufacturing one. So reviewing them is vital.
Now, this isn't just about moving numbers around in your online banking, is it? There's a big psychological piece to this.
Oh, absolutely. The material you sent really highlights this.
Right.
Just having multiple accounts changes how you perceive the money.
It's like the old envelope system for household budgets, right?
Exactly like that. But for your business, when money is physically, or at least digitally, separated into different envelopes or accounts, you feel those limits more acutely.
You're less likely to dip into the tax money to cover an unexpected operating expense if it's sitting in a completely separate account.
Precisely. And there's this idea of psychological anchoring they mentioned. By moving profit first, you mentally anchor it as the top priority. It sets the tone.
And using real, distinct accounts, not just categories in your accounting software, that makes a difference.
Apparently, yes. It creates a stronger sense of tangible boundaries, makes it harder to cheat the system you set up for yourself.
There was that quote, something like, "We don't use logic to manage money."
We use our instincts.
Yeah.
And profit first tries to work with those instincts, creating guardrails, rather than expecting pure logical discipline, which, let's face it, often fails us with money.
Okay, so for you, the listener, thinking, all right, how do I actually do this? The sources laid out 5 pretty clear steps.
Step 1, no surprise. Open the 5 bank accounts, get them set up. That physical separation is foundational.
Makes sense. Step 2.
Assess your current allocation percentages. You need a baseline. Take an honest look. Where is your money actually going right now?
Track it for a bit. See the real percentages for OPEX, what you're currently taking as pay, what you're actually setting aside for tax, and probably what your current profit percentage is, even if it's 0 or negative.
Right. Get that real-world snapshot. Then, step 3 is set your target allocation percentages, TAPs.
So where you want to be.
Exactly. Based on your business, maybe industry benchmarks, and your goals. This is your target financial structure. Compare the now from step 2 with the target from step 3.
Okay. And step 4 is crucial. Gradually implement the changes.
Yeah, don't try to jump straight to your ideal percentages overnight, especially if the gap is large. That could break your operations.
So start small. Like if your target profit is 10%, but you're at 0% now, maybe start by allocating just 1% to profit.
Exactly. Take baby steps, allocate 1% for a couple of allocation cycles, then maybe try 2%. Build up gradually. Let your spending habits adjust. Build that financial muscle.
Right. And the final step, number 5.
Set up allocation days. Pick a schedule, maybe the 10th and 25th of each month, whatever works, and stick to it.
Make it a routine.
Yes. On those days, you look at the income account, do the percentage calculations, and make the transfers to the other 4 accounts. It systematizes the whole process.
Okay, so let's recap the benefits for the listener based on what you sent. Why go through this? Well, first, sustainability.
Yeah, making profit consistent makes the business fundamentally healthier, better able to handle ups and downs.
It also leads to healthier cash flow, right? Because you actually know what money is for what purpose.
Much clearer visibility, less guesswork, less anxiety about whether you can cover payroll or that tax bill.
And there's the built-in reward system. You, the owner, are actually getting paid and seeing profit consistently.
Which acknowledges the risk and effort involved. It's motivating.
Plus, that point about increased efficiency, the constraint on the OPEX account,
forces smarter spending. You find leaner ways to do things because you have to. It can spark innovation.
Now, the material did acknowledge potential hurdles. Like managing 5 accounts sounds like, well, a hassle.
It might seem that way initially, setting them up. But the argument is, once it's running, it's actually simpler mentally than trying to juggle everything in one big pot.
Less tracking, maybe?
Yeah.
More clarity?
Right. And some might feel it's too rigid, too mechanical.
Stifles creativity or flexibility?
Perhaps that's a concern. But the counter is you can automate a lot of the transfers. That builds the discipline for you, freeing up mental energy.
And for really small businesses, is it overkill?
The argument in the sources is the opposite, actually. The smaller the business, perhaps the more crucial it is to make every single dollar work effectively. This system forces that focus.
So it ensures even tight margins are managed for profitability.
Exactly. It's about making profitability a non-negotiable from day one, regardless of scale.
Which leads back to that final quote you shared. Profit is not an event.
It's a habit.
Yeah. It's not this thing you hope happens at the end of the year. It's something you practice consistently, allocation by allocation.
It's embedding profitability into the very rhythm of your business operations.
So the core takeaway seems to be, don't wait for profit to happen to you. Make it happen by design, starting today. Build the system.
It's definitely a powerful shift in perspective, challenging that old formula and offering a very practical, behavior-driven alternative.
Okay, so wrapping this up and thinking specifically about the sources you shared with us, here's something to ponder. What's maybe one small financial habit, just one thing, you could start today to begin prioritizing profit in your business, inspired by this profit-first idea?
Yeah. Even just opening that separate profit account, maybe, and committing to putting something in it next time revenue comes in.
Could be that simple. It's definitely worth reflecting on how this framework challenges the way many of us instinctively run our business finances and what impact that shift could have, not just on the business's health, but on your own peace of mind, too.
If this deep dive sparked your interest, definitely check out more of Mike Michalowicz's work on Profit First. There's a lot more detail there.
Absolutely. Well, thank you again for sending these materials our way and trusting us to dig into them.
Yeah, this was a good one. We hope this discussion gave you some valuable insights and practical ideas.